You're looking for the crash, and that's exactly why you're about to miss the real danger. Everyone thinks waiting is a smart route right now. Waiting for prices to fall, waiting for rates to drop, waiting for some big reset. But the real threat isn't a crash, it's the stall. We have low inventory, stubborn inflation, a market that's not moving enough to scare you, but slow enough to quietly drain you of future returns. If you're playing it safe, you're actually getting squeezed right now. Because this phase, this is where people fall behind without noticing. The market feels like a held breath, not rising, not falling, just frozen. And that's when time starts working against you. And time is the one thing you don't get back. So let me show you what's really happening here and why the math in this phase punishes hesitation more than any crash ever could. The market's trapped between two forces. You have inflation that's becoming increasingly hard to tame, and there's not enough inventory. That's the vice grip, and it's explaining most everything. Take California as an example. Inventory is up from last year in some areas, a big jump in inventory, but statewide, it's still only around 3 to 4 months of inventory. And in the hotter pockets, there's even less inventory. Anything under 5 or 6 months is still a seller's market. At the very high end of inventory, 2 million and up, you're finally seeing something close to balance at around 5 to 6 months of sitting on the market. But prices, they're not ripping, they're not collapsing, they're just kind of drifting. Basically, they're keeping up with inflation. That's what I'm calling the great stall. It's a long, boring, sideways grind that punishes people who are waiting, and it quietly rewards anyone who keeps buying. Check out the headline behind me. 30-year mortgages just ticked up again. Right now we're around the low 6s in rates. And that sounds scary until you zoom out. And now I'm gonna go into weatherman mode. This is a 1-year chart of interest rates. As you can see, through the entire year, we started up, but for the year right now, we are actually at a 1-year low. So that was the 1-year chart. Check out the 50-year chart. As you can see, the late 70s, early 80s, very high interest rates. But check out a 50-year perspective. Where interest rates are right now, they're actually below average. The average interest rate is actually 7.5%. So for right now, we are in a low interest rate environment still. So all the headlines you're seeing about high interest rates, they're just not true. Now, the rates are high compared to crazy town, which was COVID, when the government was intentionally holding interest rates low. We're actually well below normal. When I started buying in 2005 and 2006, everybody thought a 6.5% interest rate was an absolute steal. So why aren't rates falling like they're expected to because the Fed's lowering rate? It's not exactly a fact, but this is not exactly well known. The 30-year mortgage, it doesn't follow the Fed. It actually follows the 10-year Treasury, like this chart I have to my left here. Interest rates follow the 10-year Treasury. There is not a one-to-one correlation between the Fed lowering rates and interest rates actually dropping. And here's what nobody else is explaining. The government and the Fed is actually in this vice grip, because if the Fed cuts rates too fast while inflation isn't contained, bond investors are going to demand higher yields. If those investors don't buy treasuries and it can't fund the government, so then the government has to print more money and that sparks inflation off again. So we're in this weird staring contest between the bond market and inflation. It's almost like the government and the Fed is in this vice grip, where if they lower interest rates, no one will buy treasuries. So they're like in this gridlock, and it is stuck between lowering inflation, lowering interest rates, and what that is going to do to the bond market. This is why you can see the Fed lowering rates, but mortgage rates not lowering and just hovering around 6. And here's the weird thing. That deadlock, it creates stability for disciplined investors, because you know the range for the interest rate, you can plan, and you can stack deals while nobody else is buying, and you can let the numbers work. So let's get into some numbers. These are numbers nobody ever talks about, and there are 4 scenarios. So we're gonna have the same house, same tenant, same city, same 10-year window, and let's look at the numbers to see how this investment's gonna perform. The only things we're gonna change is when you buy and what rate you get. So here's the setup. $200,000 rental in a Midwest market. You do a forced equity BRRRR deal, so you only have $20,000 into the deal. You're gonna hold this asset for 10 years. The asset's going to appreciate 5% a year. The tenant's gonna pay down the mortgage. You're gonna take all the tax benefits, and you keep the option to refinance. Now watch how this actually plays out over a decade. I'm going to just to test these numbers. This is scenario 1. I just blew the interest rate out of the water. I said, what's the worst case interest rate we've seen in the last 20 years? And it was 8%. So here's the scenario. You buy now, even though it's an 8% interest rate. How many of you out there would be like, no way I'd ever buy, or it would make sense to buy at 8%? Well, let's check out those numbers. So in 10 years, what this house is going to do, it'll still cash flow close to $60,000. The resident will pay the mortgage down 20 grand, regardless of the interest rate. You're going to get $17,000 in taxes, and the house is going to appreciate $130,000. So although many people have sat on the sidelines the last 2 to 3 years because of interest rates, even at the worst interest rate ever, still a 10 times return on the money. So let's take the exact same house, the exact same scenario, except you sit out for 2 years and you wait for the interest rates to go down to 5.5, and they actually do, which means you kind of got lucky. Let's take a look at those numbers. I think these numbers might surprise you. You wait for rates to go down to 5.5. You get less cash flow, because remember, you're getting nothing for the first 2 years. The tenant pays the mortgage down less, the tax savings are exactly the same, and you miss out, because you sat on the sideline, you're missing out on 2 years of appreciation. So your total return is $187,000. So there's a $40,000 opportunity cost for sitting on the sidelines. Now, let's say, hey, maybe I'm waiting because I think the market's going to crash. Let's look at those numbers. So here's the deal. In 2008, the worst crash ever, property values in the Midwest only dropped 10%. That's why I like investing in the Midwest. So I ran these numbers this way. I said, instead of buying a $200,000 house, you're buying a $180,000 house, but you still had the opportunity cost of waiting 2 years. So you had a little bit less of a down payment because you're buying the house is now worth $180,000. So your down payment now is 18 grand. But look, your cash flow is about the same because you had to wait 2 years. Your principal pay down is less. Tax savings is the same because tax savings is not dependent on interest rates. But check this out. The appreciation is about $50,000 less because you bought during a crash and then the market doesn't bounce back as fast. Now, let me go through. So of these 3 scenarios, the best scenario is to buy now. Now, let me go through the 4th scenario where you buy now and you date the rate, but marry the house. After 2 years, you refi the house when interest rates are at 5.5%. So your down payment is still $20,000. But look at your bumping cash flow. Your cash flow is $6K higher. The tenant paying the mortgage down is another $3K higher. Tax savings is the same, and the appreciation is the same. But the best case scenario is always to buy now and refi later. Date the rate, buy the house. There it is in the numbers, because I've ran these numbers several times, and it's always to get the clock ticking. And with the bird deals we do, you want the low down payment and you want the appreciation. That is your opportunity cost if you're sitting waiting. But what if the market gets worse? Well, let's zoom out a second. Behind me is a chart showing median home prices in the United States since World War II. And in the last 75 years, only 5 years has the median home price gone down. Some decades, it crushed it. Look at the 40s, 11, 17, 12, 24, 21%. Houses went up that fast in a decade. Also, check out the last time we were in the midst of huge inflation, the late 70s. 74, 10, 7, 8, 15, 16, 14, 7. Now, the market, sometimes it also just kind of jogged in place. Throughout the 50s, we're seeing single-digit returns. In the 60s, also seeing single-digit returns. What was going on in the 50s and 60s? It was probably the most stable, growth-oriented market that the United States has ever experienced. Why? Because Asia and Europe were both recovering from World War II. So we were really the only show in town. But as I just showed you, in the 40s and the 70s, when there's economic instability, real estate performs incredibly well. So the only ugly stage we've really had was 2007, 8, 9, and 10, a 4-year stretch. Like I said before, in only 6 years out of the last 75 has real estate gone down in value. The Great Recession, that was not a real estate crisis. That was a fraud and lending crisis. So as long as there's not another huge fraud and lending crisis, you can say with a certain amount of certainty that real estate is a very safe bet to appreciate. And here's the other thing about the Great Recession. Even the long-term landlords still made money. I bought houses in 2005, 2006 because the rent, tax savings, and the tenant paying the mortgage down. That's how I made money back then. So now let's be pessimistic. Instead of saying the market's going to appreciate at 5% a year, Let's look at what happened when it appreciates at 2.5. All right, so a smart investor is going to ask, okay, well, what if your primary assumption is that for this to work, is that the market has to appreciate at 5%? So let's test that assumption with the same 4 scenarios. What if the market only appreciates at 2.5%? Well, here's what the numbers say. All right, still $20,000 to invest. And just a quick reminder, this is investing at an 8% interest rate, which even when rates went up in 2023, we never hit 8%. So here's what we got. 8% interest rate, $20,000 down payment. You're going to get $22K in cash flow. The resident is going to pay the mortgage down, $21K. Same tax savings still, $17K. And the appreciation is lower, only $56K. But you still get, on that $20,000 investment, you're still getting a $100,000 return. You're still getting close to 5 times on your money. And by the way, a 2.5% increase in the market has not happened in a long time. We haven't seen that since the 50s or 60s. So let's check out scenario 2. So let's say you wait 2.5 years till you get lucky and the interest rates goes down to 5.5%. Over the course of 10 years, you'll see $38,000 in cash flow. The tenant is going to pay the mortgage down 19%, same tax savings of 17 grand, and the appreciation of 44,000. So in this scenario, you get a little bit better return of waiting if you get lucky and if there's a spread of 2.5 points on the interest rate. Like, I exaggerated these numbers. Let's check scenario 3 with a crash. Scenario 3, once again. So $18,000 down payment. Cash flow is now $41,000. Your principal pay down is $17K. Tax savings still $17K. And your appreciation is around $40K. So you edge out, if it's only 2.5% appreciation, waiting for the crash, you edge out buying now. But let's check out scenario 4, buying now and waiting for the refi. What happens? All right, so here's the principle for every real estate investor. It's date the rate, marry the house, and you gotta get the 4-pillar clock starting. So here's what we got. Now at this time, you refi at 5.5%. So your cash flow is now up to $41K. Your principal pay down is $24,000. The same tax savings is $17K, and your appreciation is $56,000. Now, where else are you going to get even 4, 5, or 6 times of your money over the course of 10 years? It's real estate. So the math proves it out. You want to get the appreciation clock starting, even if it's high interest rates, even if you're worried about a crash. The math plays it out. So you might be saying to yourself, okay, Jimmy, what scenario does this not work at? Because you're saying, oh, always buy no matter what house. That's not what I'm saying. In this scenario, if appreciation is only 2.5%, turnkey, buying a rental price at full market value, because our BRRRR keys, you buy at 85%, but turnkeys, I do not think you're going to get ahead. So turnkey used to be the easy button, but in the great stall, it just doesn't pull its weight. You might have to invest up to $50,000 as a down payment in a turnkey versus $20,000 in a discounted BRRRR key style deal. And here's the thing, it's the same house, same rent. One just makes your cash work a whole lot harder. The BRRRR keys, it extends your capital out so much farther. So this is why my team moved away from retail turnkey and we've doubled down on discounted buy, renovate, refi rentals for clients. Now I do other videos on BRRRR keys if you're not really familiar with this term, and I'll have the link to those in this video. And now everyone is talking about the proposed 50-year mortgage on paper. On paper, it lowers the payment a bit, but in practice, it actually balloons the interest payment. It almost doubles it. And sure, the government and the banks are talking about doing this to tweak affordability. It tweaks affordability, but it doesn't fix the real problem. We still don't have enough good homes in the right places. And any new demand and supply, it's usually going to push prices up, not down. So here's how I see it. The great stall isn't a waiting room. It's a filter. It separates the people who keep waiting for the perfect deal from people who are quietly building rental portfolios. They're getting wealthy on Main Street in a strategy that's hiding in plain sight. While everybody else is tied to CNBC, waiting about rates, worrying about rates, here's the playbook we run. Buy at a discount, get close to break-even cash flow year 1, and then you let the 4 pillars run, and you keep the refi option open, and rinse and repeat and stack deals on a simple schedule. So this is how you look back in 10 years and say, I didn't have to time the market. I just owned the right assets long enough. So when you step back and look at all of this, the great stall, the inflation squeeze, the inventory choke, the math behind the time, the real takeaway is simple. This phase rewards the people who stay in the game, and it quietly punishes the people who wait for the perfect, overanalyzed time to invest. Because the biggest risk right now isn't buying the wrong house. The biggest risk right now is letting the clock run while you're sitting on the sidelines and your money keeps getting devoured by inflation. And for high income earners especially, this is where the damage happens. Your money, it should be working as hard as you are. But in the great stall, it only works if it's inside real assets that compound, whether the headlines say it's a good or bad time to invest. And that's where everybody is getting stuck. They agree with the logic, they see the math, and they know they want to invest in real estate, but they simply don't have the time. And they have zero interest in turning real estate into a second job. That's where working with me and my team comes in. You don't have to take on a second job. You don't have to hunt the deals because you don't want to. You don't want to babysit contractors, and you don't want to chase rent checks just to be in the game. That's what my team does. And that's why I pulled this video out here for you to watch next. It walks through what it looks like when you plug into a professional structure that does all of this for you. The sourcing, the financing, the management, the tax strategy, so your money compounds automatically without you having to babysit it. If this video showed you why sitting still is a real danger, the next one shows you how to stay in the game without it taking over your life.